Hey everybody, my name's Tom, and today I'm going to be talking to you a little bit about Deere and Company. So, what is Deere? Deere is an American corporation that manufactures agricultural, construction, and forestry machinery, diesel engines, drivetrains, basically anything used in heavy equipment or lawn care equipment. In 2014, it was listed as 80th in the Fortune 500 Americas rankings. It was listed 307 in the Fortune Global 500 rankings in 2013. It was founded in Grand Detour, Illinois in 1837, so it is a very old company, been around for almost 2 centuries now, and it is one of the largest agricultural machinery companies in the world. It has great brand recognition, great name recognition. I would guess that most of you have heard of John Deere before. But just to give you a little comparison, the industry market cap average is about 1.78 billion compared to Deere's market cap, which is 32.31 billion. So you can see it is a very, very large company. And then we compare that to Caterpillar, whose market cap is about 42.34 billion. But when you these are competitors, but when you get down to actually looking at what drives their revenue, they actually extremely different. But we'll get into that just in a second. So break down their segments and geographical locations. They do operate in three segments: agricultural and turf operations, which is by far their largest. This is everything to do with tractors, combines, the sale of that type of equipment, construction and forestry operations, pretty self-explanatory, more your construction-based stuff, and then financial services. A lot of these farmers don't have the cash to put out, hundreds of thousands of dollars for equipment, so they do finance them, sort of how like a Honda or something would finance your vehicle. And then they break down their geographic areas into the US and Canada, which, as you can see, um, basically generates about three-quarters of their revenue, and then outside the US and Canada, so basically Eastern Hemisphere, South America, stuff like that. So this is a chart of Deere's operating profit by segment. The chart demonstrates that Deere is primarily an agricultural company, which you can see by the blue bars, which represent the agricultural and turf segments. And the growth prospects are largely dependent on a combination of farmers' income and their propensity to spend on agricultural machinery. So basically, if the farmers are making no money, they're probably gonna, just buy what's needed or maybe fix their stuff before, going out there and actually buying new equipment. But if they're making a lot of money and, they kind of want to splurge on some new stuff, then, maybe they will. So, and historically, like I just said, the two things are closely correlated. And then farmers' income is basically governed by the outlook for key crop prices, such as corn, soybeans, or wheat. So now we compare that to Caterpillar's segment profit, and you can see immediately that there is a significant fall in profitability in the resources segment, which is a consequence of falling hard commodity mining prices. They do have a little bit of an overlap in the construction industry, but it represents a relatively small part of Deere's profits. Um, and then so most of their profits are coming now from, as you can see, energy and transportation, which is by far the largest segment. So Deere's market outlook actually isn't that good, but I'm sure these projections were before the election. I'm not sure exactly how they would change after the election, but their company equipment sales are projected to decrease 7% for fiscal year 2017. The company's worldwide sale of agricultural and turf equipment are forecast to decrease by about 8%. The company's sale of construction and forestry equipment forecast to decrease about 5%. Um, and then the net income attributable to Deere & Company for the financial service operations is expected to be approximately 550 million, and then the outlook reflects less favorable financing spreads and an increased provision for credit losses. And then another thing to note is that Deere in 2012 won Most Innovative Agricultural Equipment Manufacturer, so you can see that they are investing a lot in R&D and stuff like that because they do want to have the top of the line stuff to offer their clients. So for the valuation, my earnings per share was 4.47 in 2016 and 5.15 in 2017, and then I increased that throughout by a rate of 13%. BPS was 21 in 2016 and then 23.8 in 2017. The current stock price is 102.79, and then using a discount rate of 9%, I was able to re-engineer the growth rate to bring it within, zero point 0.1 of the current stock price. and that was with a growth rate of, it was about 4.789, so I just rounded up to 4.8. But what happens when the growth rate changes? So we look at the profitability. These are three different models. The top one here uses, this is a growth rate of 5%. The second one uses a growth rate of 6%. And then the third one uh, keeps the 6%. And then the profit margin, which you can see increases by 1% every single year. The top two models, it kind of tapers off. The last 2 years, I keep it stagnant at 14.47. So the income growth you can see is 5%, 6%, and then very high here, 13.4%. So what happens when the growth rate is changed? So as you can see, this was the re-engineered one, a 9% discount rate, which brought it in between within 0.1 of the current stock price. And then we plug in the 6%, which we just determined. This raises the value per share to 133.37. And then using the last one, 13.4% is obviously just a ridiculous income growth. So keep it conservative. I did leave it at 7%. I thought about going a little bit higher, but as you can see, even 186.53 is pretty high. So if they were to see 7% growth, that you would be making, quite a bit of money. Now looking at the discount assumption, the current 10-year U.S. Treasury rate is 1.8%. I set the max at about 6.5. It seemed reasonable. The beta at 0.7, below 1 because it's not a tech company. There isn't high volatility and whatnot. So that produced the three discount rates shown below, 7.5%, 8.2%, and then the max of 9%, which is actually what I used previously when I was changing the growth rate. So this chart here looks at the outputs for changing the growth rates and the risk-free rates. So basically, as you can see, the closest amounts, the mid rate, mid growth, high rate, mid growth, and then low rate, low growth. That's actually, the closest is the low rate, low growth, but the high rate, mid growth actually isn't too far off. When you raise the rate to 7.5 and the growth to 7, though, you can see the output skyrocket to 692.2. This obviously, isn't reasonable. You would never see that, but that is what the output was. So where is Deere headed? No one rules the global farm equipment market like Deere and Company. However, though, no business is as susceptible to the fluctuations in the commodity market than the tractor business. And this graph at the bottom kind of just shows the confidence index for how farmers think their income is going to rise or fall. So starting in 2010, 2011, you can kind of see that it has been dropping, but that could be for a variety of different reasons. But the future growth of the tractor and agricultural manufacturing over the next 5 to 6 years actually does look pretty good. You see the growth rate increasing. So yeah. And then I calculated some liquidity and efficiency ratios just to kind of give you an idea of how the company is doing. Actually, all these ratios have been decreasing, but this is the first year in multiple that they actually have been decreasing, so I wouldn't consider it too much of a scare. But they aren't all too terrible. We have AR turnover dropping from 8.55 to 7.8. And then some profitability ratios such as ROA. Then we have return on equity and return on investment. Also can seem to be dropping. So where is the future of interest rates? The 10-year Treasury yields have shot up from 1.8%, which I used actually in the model before the election, to 2.1%. Right after the election, and this is actually right after the markets kind of crashed and then bounced back. It bounced up to 2.1%, and this 2.1% is the highest in nearly a year. Inflation will increase due to spending on infrastructure, tax cuts, and trade policies. And then GDP rose, just third quarter 2016, rose 2.9%. So basically what they're predicting is that interest rates could rise to as high as 2.7% in 2017. So it'll be interesting to see how Donald Trump's policies, his trade policies, affect this moving forward. Thank you.